Markets have been on a bit of a roller coaster lately, and a lot of it comes down to one thing: uncertainty. Tensions between the U.S. and Iran have pushed oil prices up, which makes shipping more expensive, which makes pretty much everything more expensive. That kind of pressure tends to make investors nervous, and right now, nervous is a pretty fair word for how Wall Street is feeling. The S&P 500 is sitting about 7% below its peak from earlier this year. That's not a crash. A real correction is typically defined as a 10% drop, but it's enough to get people asking questions. Here's something worth knowing about. There are platforms out there called prediction markets, where people actually put money on whether certain economic events will happen. Think of it like a betting market, but for things like recessions. Right now, traders on one of these platforms have the odds of a U.S. recession happening this year sitting close to 40%. Back at the start of March, that number was around 22%. That's a significant shift in a short amount of time, and it reflects how quickly the mood has changed. There's also something called the Citrini scenario making the rounds. It started as a research report that imagined a world where AI-driven job losses trigger a major stock market crash and a deep recession. It was framed as a thought exercise, but it got enough attention that people are now placing real bets on whether it actually plays out. The odds of that happening have roughly tripled in recent weeks. Economists at Fidelity have pushed back on that idea, pointing to other factors like interest rate expectations and an uneven economic recovery as bigger drivers of current volatility than AI job losses specifically, but the conversation is clearly on people's minds. The good news is there are still real reasons not to panic. Corporate earnings have held up, borrowing costs have come down from where they were, and more parts of the market are participating in growth, not just the big tech names, which is generally a sign of a healthier, more stable market. Whether things continue that way depends a lot on how long the energy price pressure sticks around. If it feeds into inflation and starts affecting everyday spending, that's when things could get more serious. For now, the best move for most people is just staying diversified and not making big decisions based on week-to-week headlines. And if you want to keep following along as this develops, please subscribe. We'll keep breaking it down as things unfold.